Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading or simply algo trading. Today I'm going to pick up where I've been talking in terms of multi-positional trading paradigms, and we're going to go over more of the intimate details of that process. Now I've already showed the charts and some of the profits. So even though we're going to take a brief overview of some of what that is not going to be the focus of this video. As we progress through this kind of an approach, through developing the layers, through looking at exactly what we are really dealing with in terms of risk and budget considerations, there is a lot of untold truths that need to be carefully examined, and why it is so critically important that you build your layers slowly and over time. So let's start with the alerts, because I have made some changes. As you can see, my most aggressive one, I have changed from 0.01% position size to 0.1% position size. That means for every one of these positions is now 10 times larger compared to what it was previously, and that has a higher risk level. It is not something I changed just off of the whim of a thought or just because I wanted to be greedy, but rather I have 50 different testing accounts involved in making these decisions. 50 different accounts that I use to test and analyze different possibilities, different probabilities of how this is going to behave as a consistent total paradigm. And you'll see that I have 6 layers in this process, 6 different alerts sending buy signals into one account on the same asset. Now I'm still maintaining the 10 pip take profit, 405 pip stop loss. So let's start with where profitability is at the moment. So as we see, the equity curve is still doing pretty well. Now as you can see, the money isn't all that great. But again, this isn't about making money at this moment. It's about proving a concept and not blowing the account up at the same time. This is real money though. Real, hard, cold cash that I have made using this approach. And now let's look at the trades. As the trades load, we can see exactly where they sit. We can see the level of volatility. We can see how quickly things sold off. We can see the instability of the market itself as this whole process comes together. But there's so much more to this process that we need to talk about. Now we are in the VPS, where the magic takes place, where the numbers actually tell the truth. And that really is the whole point of a multi-positional trading paradigm. Not the pretty pictures, not the wonderful equity charts, even though they are truly scrumptious to admire. No, this is the truth. This is where things really count. And this is only part of it, for we are looking at the profits of completed trades. And as you can see, I started trading February 15th. This is my first completed trade. It was a profit, my entry price, my exit price, and the amount of money I made for that trade. And of course, how long I held the trade. But the thing that stands out interesting as you begin to see the unit sizes and they show you the layers where I was trying and testing and seeing just what it really meant in terms of how much money each position was going to make based upon the percentage of my account. For example, here, looking at the 0.01%, it only drew in $6, or excuse me, 6 cents. But you see where I tried in a paradigm that was more aggressive, and it was extremely small amounts. Not even a full penny was brought in, even though it did exceptionally well with the trading approach. So getting your position sizes correct is critical, because as you move for this kind of an approach, position size denotes profitability. And you could have a wonderful process, but if you're not making enough profits to sustain it over the long term, it's not going to be beneficial. And that balancing act is extremely difficult, particularly when you have anywhere from 3 to 6 or more different entry positions simultaneously affecting each other. So let's continue to look at this approach and see just how well things play out as I thumb through and move some of these positions. You can see that some of my older positions, 57 days. Take time to let that sink in. I held a single position for 57 days and 20 hours. Now, this is one of countless positions, and that lies part of the problem that you need to stay aware of. Your budget has a limit, and that limit is going to go very quickly if you don't plan out your position size appropriate to the totality of the paradigm itself. So as we continue looking, 61 days. 61 days. And we continue going through the trades, and we can see many interesting patterns, although they're not as obvious now as they will be in a few moments. Okay, let's get to the most recent trades. And we can see now where, find my mouse, the position sizes start to take on, where you can see where I've added in the additional layers. 200 units, 600 units, 300 units, and even 2,000 units. The different layers starting to exert themselves, and profits starting to roll in from those layers. For example, 2,000 units brought in a $2.36 profit, whereas a layer of only 80 units only brought in 13 cents. So you begin to see at the profit level how the interactions and how the overlays begin to really play together with each level and layer. And you can see clearly which unit sizes are more obvious, that is more aggressive versus least aggressive, and how the combinations of the hyper-aggressive to the hyper-defensive interplay with each other at the profit level. But that is really just a small core component of the entire process. Now we get to the point of the video, the point where things really matter. Not the tasty profits or the pretty pictures that make up the charts, but the real underlying situation of a multi-trading position size paradigm. And that is, how many trades are open simultaneously, how many trades are active that the system has to keep track of on a constant and vigilant basis. And right now, I have a total of 65 open trades. 65 different positions open simultaneously at this very moment. And if I walk away from the table and sell everything, they're going to be worth $42, which means out of my $100 profit, if I close this all out right now and step away, I'm going to leave the table with roughly $60 of profit. Not bad, really. But that is where the problem lies, where we see how such a technique can blow your account up faster than you can realize. If you don't take the time to layer this carefully, you will be overextended and your account will be wrecked. So we can see here the stop loss value, and that is 405 pips away from the purchase value. The purchase value right now is in parentheses. This is the current ticker value of the actual position that's being tracked. So our stop loss value versus our versus the position price value that I purchased this particular one in. And then finally, we have the take profit value, where I get to walk away from the table, hopefully with money in my pocket. And right now, where the current position is at. If I was to close this position out right here and right now, I would lose 17 cents. Here is my 3% position. Right now, it is going to lose $9 if I close it out and walk away from the table. That is something to be aware of with any kind of a multi-position trading paradigm. Every single position will take a loss if you walk away from the table. Every last one of them. But in looking at this particular table, the meat, guts, and bones of the entire process, you can see my hyper-aggressive approach has the most open positions. But then you can see where I start to scale up through position sizing and actually take and weigh out the risks of each and every position taken. Now this is the bottom of the table. Let's go back up to the table and start seeing some more interesting revelations of this process. So now at the top of the table, my oldest position is at 64 days and 19 hours. So 64 days and 19 hours is my current oldest position. So I have right now active 64 days worth of trades. But here is where the truth of the market begins to show. See, this particular market has been a rather nice one because we've had a nice long-term steady trending range. That is, the range has been fixed for about 6 months. So I have a consistent area that I can work within. But even within that consistency, there is still places within the market that have settled and shifted along the way. Remember that the market never sits still, and it's up to us to follow it as much as possible for the profits we make. And that is where the open positions take on a whole new meaning. Because by seeing all of your open positions in such a way, you begin to see just where the market shifts take place by looking at price action in combination with the number of days you have held a position. For example, here is 64 days, but then you see a whole string of positions at 56 days. But then you see 55, 54. So as we begin to move down, you can see here a reasonable level of consistency for this sub-range within the totality of the bigger long-term 6-month range. But then from a certain point, we go from 54 days down to 49 days. A gap in a market that shows a dramatic market move, a dramatic position change in price due to some kind of an event, whether economical or fundamental, or simply a change in the buying pressure between the buyers and the sellers. This fundamental change took place and is very visible in the number of open trades we currently are holding. So let's continue moving down. 49, 48. So 48 days. So this particular sub-range didn't last very long. Then we went to 43 days. A very, very short price movement. And now starting at 16 days. So we have a major, significant price difference between the positions of 43 days and the positions of 16 days. And if we actually look at the buying price, we can see that reflected in the market itself. So as we continue, 16 days, so we see a fundamental, dynamic, and significant change within the market from the 48, 43-day range down to 16 days. A significant price movement. And that is really one of the most telling aspects of this particular type of trading. By understanding and seeing how long you are holding a particular position, you can get a very clear picture of where the price is ranging. That can be important because that is how you decide where to take your bigger positions. Positions that carry more risk and put more money on the line become a pivotal consideration when you know where the range has settled. Now, of course, there's always a risk, like the 43-day range. It only lasted for one trade. Very short, here and gone just like that. But the 48-day range, or the 54, 56-day range, both of those were considerable enough that you might want to consider taking a manual position within this price range, depending upon where price value is versus your risk assessment. So let's continue. We can see from the 16-day range, then we went to 15 days, then to 14 days. Then we have another gap down to 8 days. While not as drastic or dramatic as a range gap between 43 days and 16 days, it still shows a significant market movement and a significant change in market philosophy. The differences between the buyers and the sellers and where they want price to be. So as we continue, and we can see that the 8-day trend lasted so long, then we are down to the more recent short-term trades that are within only 24 hours old. So we can see throughout the 65 trades we have taken a considerable change in market temperature, a considerable change in market movement between different sub-ranges within the longer-term trending range. And that is really a critical and significant standpoint when you're looking at what to trade and when to trade it. By having this type of approach carefully laid out and tested, you can begin to understand just how the market shifts dynamically. Just this information alone allows us to look at the market, plot the regions on a chart, and begin to see just how the market is moving on a fundamental level, how the dynamics between the buyers and the sellers are playing out. We can begin to go look at fundamentals, we can look at government policies, monetary policies, different economic impacts that have caused this unique pattern. This is probably one of the biggest benefits to a multi-position trading approach that doesn't necessarily exist with any other approach. But it is also one of the greatest detriments. You could easily end up holding several hundred open positions. And that is a factor that has to be considered. As I said previously in this video, I have held as many as 95 open positions thus far since I started trading this technique. 95 total positions that could have easily have gone the wrong way at any given moment, with different levels of risk and different levels of money on the line that I could have lost. Now, the aggregation of the different layers, particularly with the most aggressive layer constantly selling off and bringing small amounts of money into the account, has helped offset my risk quite drastically. But in looking at all of these positions, you can see the downside is that I have to be willing to really hold these positions for quite a while. In this case, I have been holding for 64 days, my oldest position. This can be a problem, a very severe problem, particularly if you are trading in a very unusual market that has high finance rates. Because these positions, each and every one of them, have an associated finance rate, an associated fee that I pay for the privilege of keeping this position open, because this is a margin-based account. That is a consideration you have to think about when you are dealing with this kind of a trading approach. Any amount of fees is going to affect the long-term profitability of the position, and it's going to rot that profitability away. Even though I am making a profit, there's always the potential that I could make a loss just because the fees rot away the profits if I hold a position for too long. A drastic consideration, and one of many ramifications that you must pay close attention to. This is really one of the many considerations that go into this kind of an approach. So let me know what you think about this approach. Is this something you would use or like to use? Let me know what you think about holding so many positions open for so long. Like this video and share it. Share your thoughts. Let me know how you think this is going to turn out. Is it going to be a long-term success, or is it going to be a long-term disaster? I look forward to reading your comments. Thank you for watching, and until next time.